Gold traded relatively sideways during the past week as conflicting fundamentals appear to keep the precious price muted. Protests against the strict COVID lockdown measures across major Chinese cities grabbed gold's gains acknowledge hawkish remarks by Fed speakers. On the flip side, the November meeting minutes pointed out that the Fed officials favor smaller hikes going forth, which tended to support gold prices. In this report, we aim to shed light on the catalyst driving the precious metals price, assess its future outlook, and conclude with a technical analysis. Last week's release of the Fed's November meeting minutes weighed on the dollar, causing its retraction to levels once seen before in mid-August of 2022, while the pressures on the other side failed to capitalize on the greenback's weakness and closed this week with minor gains. The release pointed out that even though the committee remains resolute at taming inflationary pressures, a substantial portion of policymakers expressed the worries on the effects of the central bank's over-tightening efforts have on the economy. As a result, a considerable portion of members are seen favoring a 50 basis point rate hike in the upcoming December meeting as the most likely outcome, and the slowing of the pace of interest rate increases as they move closer to the revised terminal rate of 5%. Furthermore, the latest CPI print also validates the proposed slowdown, since the results pointed to a further easing of inflationary pressures within the US economy in the month of November. That being said, Fed policymakers such as St. Louis Fed President Bullard, in a speech that took place yesterday, reiterated the need for raising interest rates further and then pausing them throughout 2023 in order to attain control over inflation. On a similar note, New York Fed President Williams also said that the bank needs to press on with increase for the rate cut opportunity to arise in 2024. Overall, the comments bear the same underlying message that the bank is not over yet, but slowing the pace seems to be the base case moving onwards. Lastly, we must highlight the scheduled speech by Fed Chair Powell during tomorrow's session, and the market will be monitoring particularly close his remarks. Should the speech validate the contents of the November's meeting minutes report, we may see the dollar weaken further and, on the contrary, see the precious glisten in the eyes of investors. Beside the speech of Fed Chair Powell tomorrow, the market's attention is expected to shift towards the release of the crucial employment report for the month of November, due out this Friday. The results will be particularly important both for the market as well as the Fed, since they fall under the scope of the central bank's dual mandate. Given the latest employment report, which indicated that the US labor market remains relatively tight, showcasing its ability to create new jobs amidst tight financial conditions, the critical aspect of the report will be, in our view, the unemployment rate, since the uptick from 3.5% to 3.7% recorded last month triggered outflows from the dollar. According to estimates, the non-farm payrolls figure is expected to decrease to 2,000K compared to the 2,061K reported last month. The average year-on-year weekly earnings are expected to slow down to 4.6% compared to 4.7%. And lastly, the unemployment rate is expected to stay put at 3.7%. Should the actual rates and figures meet the expectation, we may see the dollar coming under pressure, as the results would imply a slight loosening of the tightening of the US economy. That, as consequence, may polish the shiny metals' appeal due to the inverse correlation it has with the dollar. Thank you for watching.